What's up, guys? I hope you're doing well. James here from jamesdforsythe.com. And with inflation going high, and remaining high, actually, for the past few months, at least it's been above 8% CPI inflation for the past 3 months at least. I wanted to kind of go back a little bit, a couple weeks to a testimony done by Governor Waller, Fed Governor Waller, to make that distinction. I believe it was a lecture he did at the Institute of Monetary and Financial Stability at Goethe in Frankfurt, Germany, right? So I'll head over to the screen share. Basically talks about like what the Fed wants to do with inflation and kind of how they're making those decisions. So I'll do this, head over there. I also have kind of a PDF from the BLS that I'll probably link to in the description just so you guys can go to it as well. Kind of showing some nuance to the whole jobs thing because, of course, the labor market is a part of inflation with some respects, right? So basically, he provides his outlook as well for the U.S. economy and how the Federal Reserve plans to basically reduce their target back to 2% or reduce inflation back to their target of 2%. Um, right? And so, despite a pause early this year in the growth of real GDP, if you didn't know, the first quarter for Q1 2022 had a negative GDP print. I believe it was like negative 1.1 or something. It was negative 1 point something, I think. So, but either way, um, and so the U.S. economy continues to power along at a healthy pace, as they always say. The contraction in output reported in the first quarter was due to swings in two volatile categories, inventories and net exports, and I do not expect them to be repeated, right? And so, with respect to inventories, Eurodollar University did a really good podcast earlier this week, I believe. So it'd be like middle of June 2022, in case you're watching this video later down the road in the future, where they go over retail inventories and shipping problems with supply chains and everything else, and kind of goes in depth with that. Um, so, another sign of strength in the labor market, which has created 2 million jobs in the first 4 months of 2022 at a remarkable steady pace that is down only slightly from 562,000 a month last year. Unemployment is near a 50-year low, right? And so this is why I wanted to share my whole screen, and I'll head over to here to the BLS PDF and go back to the bottom where I started. Basically, one thing you'll notice with all these graphs is we're still not back to 2019 levels, right? And so all this job growth and everything else, yes, it's increasing, but we're still like even in this category, employment and other services is not back to the 2019 high. I don't even, well, it only goes back to 2012, so maybe this isn't even a high, but with this time period, it is. And so we're not even back to trend. And that kind of goes for a few sectors like leisure and hospitality. Um, Educational services is essentially back to where it started. And then some of them are just a little bit ahead, like professional and business services seems to be like it resumed trend almost, and then so on, right? I just kind of wanted to show um, an example of why you really have to delve into the nuance of this. So, whatever the cause, low participation has contributed to the fact that there are two job vacancies for every one person counted looking for a job, a record high, and this is because of low em- labor force participation, which is what we're talking about, and why you really have to look into the nuances of the unemployment rate, because um, essentially, with low labor force participation, the unemployment rate is artificially low because that pool that they're calculating that rate from is much smaller. And so you're able to basically mathematically keep it lower because there's not as many people actually actively looking for jobs, right? So on to the CPI. In April, it was 8.3 year over year. And then this was a decline from 8.5% in March, which is primarily due to a drop in the volatile gasoline prices that we know surged again this month. His words, And so basically, gas prices are definitely up again. Um, I've been doing a lot of traveling for work. For anyone who's been watching the past few videos, I've been in and out of like hotels and Airbnbs, um, basically just traveling through the South for work. Um, so yeah, gas prices are definitely up. But meanwhile, the Fed's preferred measure is based off of the personal consumption expenditures, which is PCE, right? And basically, it's just measured differently, right? They have the kind of the same very like baskets of goods and services. They're just weighted differently, and so it's typically much lower than the CPI, as you can tell with the PCE showing an inflation rate or an increase of 6.3% and a core of 4.9. And remember the difference between kind of the total PCE is same with CPI and core is that core excludes food and energy, typically the most volatile ones, even though those seem like they're the most necessary, but that's a topic for a different video. The forces driving inflation today are the same ones that emerged a year ago. The combination of strong consumer demand and supply constraints, both bottlenecks and shortage of workers, relative to labor demand, is generating high inflation. So what they care about for getting inflation down is ultimately the public's expectations of future inflation, right? And so really, and we're going to talk about how this is if they get unanchored, right, for in terms of a long-term perspective. And so essentially what happens is when you're having this shift from when they're unanchored, right? It's when they sorry, I lost my train of thought. But when you have this shift in the kind of psychology of the public, right, to where they kind of where they think that the prices are going to continue to go up and they're just going to keep going up, kind of like an asset bubble with asset prices, like with the whole 2008-ish housing bubble, where everyone was like, real estate only goes up. Same idea, but it's with consumer prices instead. Um, and that's when you really kind of have a psychological shift when it kind of just institutes a feedback loop and inflation just goes much higher, which is something I think we saw in the 1970s, late 1970s, early 80s, with kind of the whole stagflationary environment. And I've listened to quite a few other podcasts that have argued that that's what we're looking at again from some perspectives. So there's that. And then they're not taking 50 basis point hikes off the table until they see inflation come down back to the target. And one thing to really note with the Fed is they do not like to surprise financial markets, right? And so when the market is pricing in, say, like 75 basis point hikes, then that's what they're going to do, which is what we saw, I think, yesterday, maybe the day before. Um, they just don't want to surprise the market. And so basically, at this rate, they're expecting their year end policy rate to be 2.65%, right? So higher rates make it more expensive to finance spending and investment, which should help reduce demand and contribute to lower inflation. Basically, demand destruction. That's the whole point. Because if you think about it, the Fed cannot print oil or other supply. They can basically only affect demand with the currency, and so that's what they have to restrict, right? In order to bring prices down, they have to decrease demand because they cannot increase supply, right? And so part of the way they're doing that is to start QT, which actually starts in June 1st. So it's already started about 2 weeks in. The pace that they're wanting to do, let's see, by September, they anticipate having up to 95 billion of securities rolling off of the Fed's portfolio each month. So they're not necessarily, seems like they're not selling them. They're just letting them mature and roll off of their balance sheet rather than actually selling them into the market. Um, so at this pace, the Fed will reduce their security holdings by about 1 trillion over the next year, and the reductions will continue until security holdings are deemed close to the ample levels needed to implement policy efficiently and effectively. And so this word ample here is chosen for a reason. It's because the Fed operates in an ample reserves regime, which I have done a video on, and there's also a blog post on my website for, really kind of going into what they mean by ample amount of reserves. It's kind of like the definition of full employment, where it really floats depending on, an ample amount of reserves is basically defined as having enough reserves in the system that it doesn't break. And that's pretty much it. Um, so, yeah, and kind of a little bit more of an aside almost. So in terms of this QT and everything else, we're starting to see this worldwide. And so central banks over the entire planet are doing this, at least the major countries. And so you have, I don't know why I deleted this, but the European Central Bank, the ECB, is starting to signal that they're going to start raising policy rates this summer. Mexico and Brazil have already increased them substantially. Bank of England is raising rates in the second half of last year. They already did. The Bank of Canada lifted off in March, and then the central banks in Australia and Sweden pivoted sharply to hike rates in their most recent meetings, so they're going as well. Um, and then they also have just a graph to show. He's got a slideshow showing the different policy rates, right? And so you have essentially what they're doing, right? All projecting to go up. I don't know why it does it twice. But okay, so this worldwide increase in policy rates unfortunately reflects the fact that high inflation is a global problem which central banks around the world recognize and must be addressed. So we have slide 3 is the Bank of Canada and Bank of England have begun to shrink their balance sheet by stopping full reinvestment maturing assets, similar to what the Fed is doing. Is that all I had? And then it goes into my thoughts on like unemployment and stuff, or what I was thinking through. But here we're looking at the central bank security holdings period. And so this is another chart you have where you have this blue is the ECB, and you can kind of just see you got European Central Bank, Bank of Canada, Bank of England, Bank of Japan, Federal Reserve Bank, and then kind of the total of all of them. So you can really start to see the trend. How is generally having a kind of a quantitative tightening in all of 2020 or 2019, and towards you see it's barely negative, at least respectively, and then what everyone knows happened, and it just spikes and goes up to a peak in the middle of 2020, and then it's just kind of been a steady increase the whole time. Because remember, this is their net purchases for each quarter, and so this is cumulative as it keeps going up. Every quarter that this remains positive is a net increase of assets on their balance sheets, and so we're just now starting to see some start to decrease, with one of those being, let's see, looks like the Bank of England was negative in the beginning of 2022, and so on. So yeah, as always, I'll leave a link to the actual source and stuff in the description so you can look at it if you want. I'll find a link for the ample reserves regime video and such, just so you can check that out as well. Look more on that. And as always, I always try to put the sources and where I find the information in there so you guys can look at it as well. But yeah, I'll leave it at that. So I hope you guys have a good day, and I'll see you on the next one.